So when someone says Turkey, what do you think of? A tourist destination? The Ottoman Empire? A bird? Or maybe even the Salt Bay? But the strangest thing here isn't any of that. It's in fact Turkey's economy. In 2022, Turkey's inflation suddenly went bonkers and skyrocketed to over 80%, while the Turkish lira went on a diet, losing half of its value within a year. Sounds bad, but while all this was happening in the same year, Turkey's GDP was like a contestant on a talent show and surprised everyone with a growth of 5.6%, and their stock market even tripled in value. Even stranger than that is its president. He constantly rails against the heavens, the earth, and interest rates, calling them the devil and that we should have a little faith in Allah instead.
Allah bizimle beraberdir.
A big country with a population of 85 million and a top 20 global economy playing by its own set of economic rules. Remember when Trump said he wanted to destroy the Turkish economy? Well, Turkey's president basically said, bring it on. So what on earth is going on? Let's dive in and make sense of this crazy Turkish economy. First, let's look at Turkey's background briefly. Initially, Turkey was quite isolated and developed slowly on its own. But after World War II, as Turkey observed Europe unite and prosper, it too wanted to be part of that growth. Turkey repeatedly tried to join the European Union's predecessor, the European Economic Community, EEC, and opened its doors for Western investment. However, this openness led to issues. Turkey ended up with a lot of foreign debt because it opened up its economy too much too quickly. To manage this debt, the Turkish government's main strategy was to print more money and then exchange it for dollars to pay off the debts. This approach, combined with the impact of two oil crises in the 1980s, kept Turkey's inflation persistently high, with rates sometimes going above 120%. And with this, we've touched on the two core issues of the Turkish economy: foreign debt and inflation. The Turkish government eventually realized that continuing on this path would only wind up with Europe. So, starting in 1999, Turkey began a series of determined reforms to address these issues. The most important one was to make its central bank independent from the government. This is a big deal in modern economies because central banks have a lot of power. They can print money and set interest rates. Imagine if everything were up to the government. It would be very likely to become a printing press in the government's own backyard. Even if the government was careful, people and businesses might still be hesitant to invest or trade with them. So the Turkish government had to take a tough decision to let the central bank operate independently. This meant that when the government wanted to borrow money, it had to follow the rules of the market. If the market thinks there's a high risk that Turkey might not pay back its debts, or if they're worried about inflation in the future, they won't pay much for Turkish government bonds. This puts pressure on the government to manage its finances and keep inflation under control. In the years that followed, the Turkish government spent less and worked on reducing the amount of debt compared to the size of the economy, also called debt-to-GDP ratio. Turkey worked very hard and managed to lower its debt-to-GDP ratio to 30%. One thing you need to understand is that having this ratio below 50% is considered very, very healthy. I won't even mention countries like the United States or Japan, which are quite wild in this aspect. And even the very restrained German government has almost never fallen below 60%. So you can imagine how impressive Turkey's 30% is. At the same time, Turkey liberalized its financial controls, letting its currency, the lira, freely adjust to supply and demand. And to deal with high inflation, Turkey did something extremely crazy. They raised the interest rate to 100%. So, what was the outcome? Well, it crashed. The Turkish lira plummeted by more than half in 8 months. But actually, it wasn't too bad. This was just a temporary pain after changing the financial controls. The lira stabilized eventually, and high inflation was quickly brought under control. But the high interest rate of 100% had a strong side effect. It didn't just lower inflation, it crushed it. Because the lira's value fell so much, at one point, people literally needed millions of lira just to buy a meal, which was pretty crazy and made everyday business very impractical. So, in 2005, Turkey introduced a new currency system where 1 new lira was equal to 1 million old lira. Now, a meal cost around 10 lira. After these reforms, Turkey experienced a period of growth. There was a lot of foreign investment, which really helped the economy. From 2001 to 2016, Turkey's annual GDP growth was usually between 5% and 12%, except for a small dip during the global financial crisis. Inflation was kept quite low overall. Turkey's heavy industry, textile industry, and agriculture grew quickly, and export volumes increased sixfold in 8 years. The tourism sector also boomed, and by 2019, Turkey was the 6th most visited country in the world, earning over $30 billion a year from tourism. However, despite all these positive changes, there were still 2 major challenges lurking in the background. One major issue for Turkey was its ongoing trade deficit, meaning it was buying or importing more from other countries than it was selling or exporting to them. This made Turkey one of the world's top countries by trade deficit. To buy things from other countries, Turkey needed to use dollars and euros. So where did all these dollars and euros come from? That leads us to the second big problem: external debt. Didn't we mention earlier that government debt was continuously reducing? Well, while the government was reducing its debt, private sector debt, including debt from businesses and individuals, was actually increasing. Now, borrowing money isn't always bad. It can be a sign of a healthy economy where people are investing and buying things. But Turkey's problem was that a lot of this debt was in foreign currencies like euros and dollars, not in their own currency, the lira. Why is this a problem? Because it means you can't solve it by printing more of your own currency. Turkey, trying to get closer to the European Union, made it very easy for its people and businesses to borrow in foreign currency. With lower interest rates in euros and dollars, Turkish businesses found it attractive to borrow in these currencies. And by 2019, over 50% of Turkish household savings were in foreign currencies, not in lira. This situation is often called dollarization, but really it refers to all foreign currencies, not just dollars. In general, it's not a big deal for people in a country to have a lot of foreign debt, but it becomes a huge problem for the country if they can't pay it back. But things got interesting in 2014 when Turkey elected a new president, Erdogan. He was already popular from his time as prime minister since 2003, and he had a lot to do with Turkey's prosperity. But as president, he took Turkey down a pretty unusual path. It wasn't exactly a dead end, but it sure was different. Despite Turkey's rapid growth, its huge trade deficit was causing worries about a dollar shortage, and the Turkish lira began to fall continuously. Then, Turkey bought some fighter jets from Russia. Now, Turkey is part of NATO, and buying jets from Russia, that didn't sit well with the United States. Trump was all over them with tweets like, "I will totally destroy the economy of Turkey." Yup, that's what he tweeted. He even slapped punitive tariffs on Turkish goods. But Erdogan, tough as nails, wasn't intimidated. He proudly said in a speech, "Forget the US and their dollars. We have our people, we have Allah."
Allah bizimle beraber.
But the markets, they were spooked. They were already nervous about Turkey's dollar issues, and now a confrontation with the US? Things look bad. International investors started to bail. From 2018 to 2019, almost half of the foreign investment left, and the lira took a swan dive, or perhaps more fitting, a turkey dive. Remember the foreign debt the Turkish population had taken on? If foreign capital were to withdraw overnight, personal and corporate finances in Turkey could collapse. And with the lira dropping, inflation, which had been under control for a decade, started creeping up again. So, the Turkish central bank did what you would expect. They raised interest rates to tackle inflation and stabilize the currency. This was the right move. But then Erdogan jumped in and said, "No, we shouldn't raise rates, we should lower them." He called interest rates the root of all evil, and basically said all the economists are wrong, that lowering rates would squash inflation. You might be curious about how he came to this conclusion if he hasn't gone mad, but we'll analyze this later a little bit. Erdogan strongly demanded the central bank to cut rates. The central bank governor, being an economist, must have thought, "Mr. President, this is nuts. How can we cut rates with inflation so high? Haven't you been watching economic narrators videos?" We mentioned earlier that the government had just made the central bank independent. So in theory, they didn't have to listen to Erdogan. It could ignore his words, but Erdogan was well prepared. So, in 2017, he amended the constitution to grant himself the authority to raise interest rates. Normally, raising rates can help control inflation, but he basically said to the central bank governor, "So tell me, Will you lower them or what? And when the governor didn't lower them, Erdogan was like, well, you're fired. So in 2019, he fired the governor and brought in someone who would listen. Hello, new governor. Now, lower those rates. Imagine what happened then. The markets freaked out, seeing such a strange move from the president, and the lira started to plummet even more. The new government then tried to stabilize the lira by increasing rates, but yup, he got fired for it. Another governor came in, had to raise rates within 2 days, and yup, got fired too. Within 2 years, Turkey's central bank governor was fired 3 times. Then another one came in, totally willing to do what Erdogan said. Lower rates? Sure thing. This meant the independence of Turkey's central bank, something they had worked hard to establish, was pretty much undone by Erdogan. Even Turkey's former prime minister, once Erdogan's right-hand man, said, Erdogan doesn't get economics, and neither do his buddies. It's like he's from another planet. That's a polite way to criticize someone, right? So what does Erdogan think about all this? Well, I can't read his mind, but from his speeches and interviews, he seems to have his own logic. You want to talk economics? Come on, I'll teach you my economics. Lowering interest rates boosts demand and investment, right? That increases the supply of goods. If supply goes up more than demand, won't prices drop? So inflation is controlled and growth continues. What he says isn't completely without sense, but usually, low interest rates can make the economy too hot and actually increase inflation. This might be a bit confusing, so let me give you a not necessarily perfect analogy. Imagine a sliding car. To stop it, most people would think you should pull it back. But Erdogan says no, push it instead. It'll go faster, create more air resistance and friction, and eventually slow down. Of course, economics isn't as exact as physics, but this gives you an idea. Hearing this, you might think, does this guy have any common sense? That's pretty much how economists feel about Erdogan's approach. Erdogan has a unique theory about interest rates. He wants to lower them whether the economy is too hot or needs a boost. His ultimate goal? To bring interest rates down to 0, no matter what the inflation rate is. But why is he so set on 0 interest rates? Well, it's largely because of his religious beliefs. You see, Turkey is a predominantly Islamic country, and Islamic teachings consider charging interest as sinful, believing that making money from money is wrong. That's why Erdogan calls interest the mother and father of all evil. This belief makes banking in Turkey quite complicated. Banks can't operate in the usual way because charging interest is seen as inappropriate. So they have to find creative ways to work around this. For example, if you want a home loan in Turkey, the bank can't just give you money and charge interest. Instead, they have to purchase the house themselves and sell it to you at a higher price, effectively giving you a 0-interest loan. Or they could rent the house to you, adjusting the rent as they please. Basically, Turkish banks do all they can to avoid the traditional concept of interest. This shows how strongly Turkish people reject the idea of interest. Now let's circle back to Erdogan's policy of lowering interest rates and look at its outcomes. Unfortunately for Erdogan, this period coincided with the 2022 energy crisis, which hit Turkey hard as a major energy importer. Look at Turkey's inflation rate. Within 6 months, it soared from 20% to 80%, and this is just the official data. Unofficial estimates suggest it could be between 100 and 200%. Foreign investors panicked and pulled out, causing the lira to lose half its value in a year. If Turks could exchange their money for foreign currency, they would do it immediately, or else they'd be in trouble. Think about that. If the bank's interest rates are so low and inflation so high, who would save money in the bank? So people started to consume, stockpiling goods, buying houses, buying stocks. As a result, in 2022, while other countries' markets were struggling, Turkey's stock market went up by 300%. Domestic consumption soared too. Even with the global downturn and the energy crisis, Turkey maintained a 5.6% growth rate in 2022. And on paper, this looks great. Higher consumption, booming stock market, growing GDP. It seems like Erdogan's strategy to boost the economy by lowering interest rates worked, right? But there's another side to this that is hardly ever mentioned. If you ask the Turkish people, almost no one will tell you they feel richer or happier. Actually, most people are engaging in panic consumption or panic buying of stocks. Not because they have more confidence in the future, but because they're consuming and investing out of fear. So while the GDP rose, the general mood was one of panic and not sustainable growth. And there's yet another point. While wealthy families and businesses in Turkey can exchange their money for foreign currency or invest to hedge against inflation, the poorer population has no such options. All they can do is watch the value of their money shrink as their wages can't keep up with inflation, further increasing the wealth gap. Nearly half of Turkey's population earns only the minimum wage. And if you look at Turkey's age demographics, it has a large youthful population, ideal for economic growth. But under Erdogan's rule, around 300,000 educated young people are lost to other countries every year. A survey by a German company found that 73% of Turkish youth want to leave the country for better opportunities. It's obvious that Erdogan was facing serious challenges with public discontent and Turkey's inflation. But he was not just sitting by idly. Apart from insisting to keep interest rates low, he had a broader strategy. He knew Turkey's biggest problem was capital leaving the country. He was worried everyone would switch to foreign currency and couldn't let that happen. At the time, he was also concerned about the upcoming presidential elections in June 2023, where his re-election was on the line. So, Erdogan did two things. The first was to prevent capital outflow. To encourage people to keep their savings in lira, the government put some limits on how much foreign currency banks can hold. He also introduced a very imaginative solution, a foreign exchange protected deposit system. This means if you exchange your dollars for lira and the lira's value drops, the bank will compensate you for your loss. So essentially, the bank takes on the risk of the exchange rate. The second strategy Erdogan used is to attract foreign capital or to build alliances. The one main reason why Turkey had such severe inflation last year, including a constant trade deficit, is because it's a huge energy importing country. Unfortunately, despite its geographical location, with Russia to the north and the Middle East to the south, Turkey itself has little fossil energy resources and has to import over 90% of its energy. This time, Erdogan realized the importance of energy and started to foster good relations with these fossil fuel-rich countries. And even though he's a member of NATO, he opposes Western sanctions on Russia and actively trades with Russia. After the Russia-Ukraine war started, trade with Russia increased even more, and he successfully secured $9.1 billion from Russia to build his own nuclear power station. He's also mended fences with the UAE, signing a $4.9 billion currency swap agreement, and improved relations with Egypt, even meeting President Sisi, whom he used to call a murderer and barbaric. Additionally, Erdogan has secured $15 billion in loans from Qatar and Saudi Arabia. In just over 1 year, Erdogan has become buddies with countries he previously looked down on and attracted several tens of billions of dollars in investment. As you can see, these countries are all major energy players, and his future energy imports will depend on these newly befriended brothers. I can only say there are no permanent enemies, only permanent interests. On February 6, 2023, Turkey was hit by two massive earthquakes of 7.8 magnitude, resulting in at least 50,000 deaths. The total cost of the earthquake to the Turkish economy is put at about $104 billion. This will have a huge impact on the confidence of the people, government debt, and inflation. As to whether Erdogan will be able to control it, or if it'll turn out like Venezuela or Argentina, I do not know. Only time will tell.